All right, everyone, welcome back to the channel, your number one source for income-oriented investing. I got our returning champion, the options king in the US, Jay Pestricelli from Zega. In case you didn't know, he's the brains behind the option strategies of YieldMax as well as the Defiance funds. How you been, Jay?
Good. It's great to be here. Thank you for having me back. A lot of news to talk about. And thanks for saying options king in the US. I don't know what I can't be the global options king. Maybe sometime. Who knows?
Well, the
I'll
US, the
work on
US is king anyway. So
it.
let's
Okay.
so that means you're the global king for sure, for sure.
Sounds good.
I mean, you're definitely the go-to that is one of the best that explains the options to regular people. As you know, I'm not an options expert. I never traded options. I rather leave it to you guys, the experts. So big news to discuss. So you went on a few of my fellow YouTuber channels already. I actually showed a video, but you know what? I just got more questions, and I figure why not come on back on the channel. You're more than gracious to always come anytime back on the channel. So I want to thank you. My audience thanks you. So let's start talking about the distribution schedule changes for the YieldMax fund. So in case I'm sure most of my audience knows, you go on the website you see here. So a couple of things. Number one, for YMax, which is my personal favorite yield max fund because it just has all of them, right? You don't have to pick and choose, but some
Right.
people like to pick
Right.
and choose. So YMax, YMAG, which is the Magnificent Seven, these two in particular are switching to weekly distributions. And then what you've done is, stop me at any time, for all the single ones, if you scroll down, you basically separated them into four groups. So they each have their own distribution schedule. And my opinion is you kind of did that. So if people want to really have weekly cash flow, they could pick and choose, single stocks, the single yield max from each group. So basically they'll kind of get a dividend or distribution every single week. Do I have that right? Did I make any mistakes? Why did you
No,
guys
no,
do this?
you got it exactly right. YMAX, YMAG going to weekly,
Mm-hmm.
and then the contributors to YMAX and YMAG are now staggered. So into groups of four, and each group will pay on a weekly basis. So yeah, the only actually look at the group C, right? Ulti is an interesting one because it's not in YMAX. We put it into one of the groups, so it will have its payment in the weekly cycle, but it is not going to pay weekly. It is still, because of the way the options run there, it just
Yeah.
still makes sense to do, go 4 weeks and then do the calculation on the payment. You got it right. So the a slight change on this, or something that folks may notice, is that now you've got four groups paying out over 52 weeks. You'll get 13 distributions throughout the year instead of just 12. But the distribution rate should not change. The dollars per distribution might vary a little bit, right? Because now there's one extra one throughout the year, but on these now you're going to get 13 payments. And you're right about YMAX, YMAG. That'll then just kind of aggregate the dividends that it receives and then turns around, pays that out for that group the following week. So those are going to be weekly, and these will be staggered, into four groups that pay weekly.
Makes sense. So if you don't want to pick and choose which yield max, which stocks, you get the Y max, you'll get paid every week, or
Right.
Y mag if you want the Magnificent Seven, or if you're a yield max stock picker, if you choose, let's say you have Tesla, Nvidia, Connie, and Amazon, or I think this one's MicroStrategy, you're
Yep.
kind of getting a weekly payment because each of those is paying at a different time in the month.
Yeah, and those are our four most widely held tickers. So we thought
You
breaking those
separated
up
them.
because, yeah, so a lot of folks, hey, if you hold these four, you're going to get, a distribution once a week at that point.
Yeah, yeah, I think they are, right? Tesla, Nvidia, Connie. Yeah, I mean, the really really high yield ones. These are some of the really really high yield ones that are
Yeah,
more
and we
successful.
also, if you notice, matched up the inverses, right? Tesla and Crash, Nvidia and Dips, Coney and Fiat. Those are together as well. We don't have an inverse MicroStrategy, but we put the Qs in that final week. So if you're one of those folks that likes to pair the long and the short, the bull and the bear versions of YieldMax, then we thought that made sense to line those up
Okay.
together as well.
Okay, so just before we talk about the strategy shift, the call spread, which is what I really, really want to talk to you about, just a quick note that you're for QQQY, JPY, and the Russell 2000 one from Defiance, not the target ones, not the 20% yield target ones, but for the original the OGs of the daily options, these are also switching to weekly. Is that correct?
Yes, we are switching these to weekly as well because they are the same day and 1 day trades. It's easy to move those to weekly. We're done at the end of the week. We know what we made, as opposed to like YieldMax, where sometimes the trades are 2 weeks or even less than a week. It would be a little weird with the dividend fluctuation. But with these,
Hmm.
yes, these have moved to having weekly distributions as well.
Those ones, but not the target ones, not the T's.
Not the target ones. Again, those are more of a, it's kind of defined number. It doesn't make that much of a difference, right? Going to paying out, I think they're 20% a year
20% a year,
versus
yeah.
doing that, monthly versus weekly. It's the number's defined
Yeah,
already.
and just right off the bat, I mean, you got SPY T, QQQT. Any launch date for the Russell one, or has that been
Nothing we've announced.
nothing you've announced?
It's
Okay,
certainly on the block. Yes.
okay, so perfect. So moving on from the weekly, I know pretty gaining popularity in the U.S. So I understand why you're doing it, but that's honestly not really why I wanted to have you on. I wanted to have you on to talk about the strategy change, and when we talk strategy change, we are only talking about YieldMax for now, right? So
Correct.
opportunistic call spreads. This is something now that you guys have the ability to do on all the YieldMax single stock ETFs, which of course it directly impacts YMAX, the all-in-one, right? Because
Correct.
YMAX just holds all of them. So let's just start with what is an opportunistic call spread, and pretend you're talking to the dumbest person in the world here.
Well, look, you're not the dumbest person in the world, but let's go through this. So, look, a call spread versus just a short call. It's you're selling a call, usually out of the money for us, and then buying another call farther away. So, what does a call spread do? Spreads in general. This is known as a credit call spread. Or even known as a bear call spread. This is designed to generate income premium selling, but limits the amount of loss
Mhm.
that spread can take, because as soon as the stock goes up through the long leg, then you're done, right? The loss of that call spread is capped. Whereas when you just have a short call, you have unlimited risk. If the stock keeps going up, you continue to lose on the call on
Yeah.
the way up.
J-
And so
just
when you
just 2 sec when you say short, because in Canada we don't have that. Short call means a covered call, a classic
sorry, a
covered
sold
call.
call, cover
Call
call,
option. Yeah, in the
buy.
US, you guys reference it as all the time a short call. Well, it's just a regular normal covered call with a strike price. That's it. Sorry to interrupt. Keep going.
No, no, that's good. That's good. We want to make sure I speak in the right lingo
Hmm.
here. And then the bought call, which is the long call above it, then kind of caps you to a range on the amount you have to pay to get out of that position. So when you have a covered call, the
Yeah,
short call itself always caps the upside movement of the stock, right?
yeah,
If it goes through the strike,
yeah. You're
you're
done.
done. We all know this.
Yeah.
That's just the way covered calls work. Well, with I'll call it a covered call spread, you're only capped between the strikes now. So if you get one of those big runs that we've seen in Nvidia or Apple or Tesla, like those big runs, you're going to have a greater participation, the chance for a greater participation in the upside movement of the underlying stock, right? One of the biggest criticisms that you hear about a covered call strategy is, yes, I got the premium, and yes, that was juicy premium, but the performance of the underlying NAV may not look so great because we got capped too often. And my response has always been, look, that's why you got the premium. You got paid that cash for giving up the
Yeah.
upside. You're in this because you want the cash. Well,
Especially when stocks are rocketing, right? When stocks are flat, I don't think anyone's ever going to complain about that. But when the stocks are rocketing, I'm losing all this upside, right? So would you
yep.
say that is the primary reason you're integrating this new strategy, is to capture more upside? Or is this the point of a call spread typically? Is it to capture more upside? Is that the only benefit, or are there other benefits as well?
The main, no, you got it. The main benefit is to not cap your participation in a quick or fast moving stock that's moving up. For us, there's always the, well, why wouldn't you always do this call spread? And the answer is, we weren't sure people would be familiar with this concept, right? We thought, oh no, now there's some complicated option strategy out there. Stick with the covered calls. Most people understand the concept of a covered call. This isn't much different. The question that I always get is, all right, but how much are you giving up and paying for that long call? Because it's not free. There's a cost associated with that long call. Well, for us at YieldMax, the answer is yield is first and foremost. We've said that all the time.
Yeah.
So we make sure we don't sacrifice yield by bringing down that short call spread. So we might get a little closer to the money. Instead of selling 5% out of the money, maybe we're 3.5% out of the money. And then that extra premium pays for the long call that gives you the upside participation. So our goal is to not give up yield or distribution rates. We know that's really important. We don't want to sacrifice that. We still start with that, and then we, add in that long call when we think it makes sense. The term opportunistic is there on purpose. We won't always do it. It just depends on what's going on with the stock, what's going on with the options. There, so I'll pause there. We won't always do it. We're going to do it when the options market and the chart will tell us, look, this is a good time to react with a call spread because you don't want to get whipsawed and get capped out. So I'll pause there for a second to see if you have feedback, and then maybe I want to talk about some times where we will make the decision to add or not add.
That's exactly what I was gonna ask you. So give me an example where, okay, let's do a call spread.
Yeah, so let's
Is it a
take
stock that's rocketing,
uh,
or is it an event coming,
probably.
or
Yeah, so you're right. So a stock that's rocketing, usually if it's at its highs already, we're going to sell calls and keep rolling calls just like we've always done, right? Upward movements, great. You got appreciation, you got your yield, you're capturing, you're growing. That's all great. The times where I think we'll use it more opportunistically are where a stock gaps down very, very quickly or moves down over a short period of time. We cover by our short call, which we do that, right? When our covered call makes its money, then we'll cover it back, we'll buy it back and do another one. Well, you don't want to get whipsawed in those scenarios, right? I'll give you an example. JP Morgan last week and even Google last week, those two underlying tickers had a pretty bad day. I think it was Monday or Tuesday of last week for whatever the reasons were. Well, in those scenarios, we bought back the short call, the covered call that we had, and then we added in a call spread instead because we know what can happen here, right? Stocks may
rebound?
rebound just as fast as they go down. And we don't, and this is the biggest challenge of any covered call strategy, not just YieldMax, but any covered call
Yeah.
strategy where you're limited on the up days and your full participation on the down days. We would like to have more upside on those scenarios. So yeah, those are some examples of when we'd use it. Let's say earnings are coming out, right? Maybe
Mm-hmm.
there's an opportunity where we could put it on there as well. I think it's, we may leg into it. Legging in is a term we use where you had the short call and then you put on the long call later, right? There's those kinds of opportunities as well. Maybe it's a way instead of selling the short call, the covered call we had, buy one lower to give yourself. There's a lot of different option results that happen once you can start using spreads. But the goal here is still first and foremost yield. We haven't changed our target distribution rates. We haven't changed the math of using the implied volatility. That all stays the same.
It's almost like an extra tool that you guys have in your tool belt in your actively managed portfolio, of these to make an additional decision. Okay, the stock went down. We feel like there's going to be maybe some more upside in the next day or week or so. Let's do a call spread. So we'll capture more upside if it rebounds. So do you think the main impact of this is, in a general sense, in terms of, I always have YMAX in my head, like all of them. Do you
Yeah.
think overall are we capturing, or there's more potential to capture more upside?
Yeah, that's the way to look at it. There is definitely more NAV appreciation opportunity as we're capturing more
Okay.
upside, right?
Would you?
So we're still going to have the distribution rates that we have, which is always strange for the NAV, right? We know how that can always look, which is why we look at things on a total return basis. But now you have more upside, the potential to have more upside in NAV appreciation with the call spread.
I like
Correct.
that. What about
Correct.
the yield? Do you think it'll impact the yield a little bit, a lot, or none at all?
Our goal is to have it impact the yield, not at all.
Okay.
I could think of a scenario where it positively impacts the yield. So let's say the call spreads end up stopping us from being capped on an up move. And we have to, we roll our synthetics, right? We take that combo, the long call short put that represents a long stock, and we have to roll that. There might be greater profits in that roll, which eventually we're going to have to distribute. So, look, I don't want to promise that this will improve yields, but we have to distribute profits, right, and
Yeah,
gains. And so,
ETFs, yeah.
yeah, so when we don't, so when the today with the short call, it costs money to get out of a short call that's in the money by 5, 10, $20, right? That costs money to get out of it. That usually offsets some of the gain of the synthetic. Now, if that cost to cover is limited, we no longer have that problem of, offsetting the gains of the stock. We've got this stock growth or stock participation now to the upside. So I think that can help distribution rates, and I think it can help NAV. On the flip side, this doesn't hurt us because we're not. If the stock goes down, it goes down, right? Like the same scenario happens. We're going to have the same yield that we sold the call spread for the call, so it shouldn't disrupt the distribution rate on the way down. But on fast moving stocks or stocks that are moving up,
Hmm.
there's a chance it could improve it.
Awesome. And I'm assuming on the website you'll update it, if one has a spread or not, we'll be able to see that in the intraday trades. I know I don't do this personally. I don't like a lot of the other YouTubers, they'll analyze it every day. They're making updates. I don't do that. But if we want to see it, okay, does this one have a spread or not? We could actually just go on the website and see which ones have it, which ones don't at
Absolutely.
that moment in time. Okay.
Yeah, the positions will be in there, and I think we're forcing people to take their next leg in journey of option education by learning how spreads work, which is, again, long term, I think a much bigger news than any of the weekly stuff that we're talking
It's
about. I
huge.
think
And
these have long term impacts.
it's basically what SPY-T and QQQT are doing. It's a daily spread, right? It's a very similar type of thing. Would you say that's
Yeah, that one,
correct?
those
Or
are daily. That's correct.
those are,
This is
yeah,
going to
that's
be
daily.
monthly or week. Yeah, the weekly or yep, you got it. You got
Okay.
it. More
And
upside capture.
all right. And for my audience, that's more like me, that doesn't really, would you say that adding this, does it increase risk, lower risk, or doesn't have an impact on the risk of this
Let's
fund?
see. So I would say because there's a chance of capturing more upside, I would say it should lower risk. And because we're not going to lose more on the down moves, so the downside risk would be the same. So, downside risk still exists just like before, right? We, going to capture whatever it is, 80, 90% of the declines of an individual stock. The upside now that I used to say was 60, 70% might be a little more, which look, as stocks generally go up over time, right? Who knows on individual names, but yeah, it probably ends up lowering like the Sharpe ratio, which is a reward to risk calculation. So I think it probably lowers that because you have the chance for higher returns.
Okay. From a technical standpoint, you would say
Yeah,
it could lower it. So, and just to finish off this conversation, I got one more question to ask you, which I'm pretty excited about, something I've heard. Maybe you've heard, I don't know. Would you say that all of the, the single stock ones, the main risk is always tied to the underlying stock? That's still
absolutely.
correct, right? I mean,
That's the number
Connie,
one
the
risk.
risk is Coinbase. At Tesla, the risk is what Tesla is doing, et cetera, et cetera. So I'm speaking more to my audience here. Just remember, when you buy a Connie, it's a lot more risky than a YieldMax that has all of them, right? Just like buying a single stock is a lot higher risk than buying a Nasdaq 100 index or something like that. So just very important, I think, for people to understand that. So let me just see if I have any other questions relating to the call spreads. I don't think so. I think you answered all of them. More risk, less
You
yield.
brought up Coney. Do you mind if I use that as an example? Because that
Of
was one of the
course, if you want to
first
share your
tickers.
screen, I think you had some examples you wanted to share of how this call spread is actually helping in the short period of time that you've been using it. When did you guys start having the ability to do it, by the way? Has it just been a week or two?
Really, yeah, we just started. I think the first ones that we put on were, I'm looking at the calendar here, probably the 6th, right? I think that was the first time that we were able to put on call spreads, and I think Coin was one of the first ones that we did it for. So sorry, I meant September 6th. If I said August
Okay.
6th, I meant
And
so
by the way,
this is fairly new.
No MER increases or anything like that with this.
Nope, no
Okay.
increases. Nope,
Okay.
you got it. You got it. So let me, yeah, I will share my screen here. So we're going to look at, a Bloomberg screen. This is just a snapshot of how we, here we go, of how we kind of look at how stocks, you could compare two stocks. So here we're looking at Coinbase from the week, the time frame of September 6th through today, actually, when we're recording this.
Yeah.
And here's kind of right now, because it's such a short period of time, price return and total return are the same. There's been no distribution here. So when you look at this, when we began utilizing these, the upside participation in coins bounce over the last, I'll call it 10 days, but it's been like, whatever, 7 market days. Very little has been given up for the income that we
Yeah,
received,
very
right?
close. Very
Very,
close.
very close,
Yeah.
right? So this is one of those scenarios where, if and then let me even go back a little farther here. So now I'm kind of working without a net. Don't remember what this will look like, but let's just see. When you go back even farther, so this is a great example of how this strategy really can work. So coin is down 23% back to August 23rd. I randomly picked that day, no cherry picking. And you can see Coney is down, less than that. So
Yeah.
lost less on the way down. That's what you
Outperforming.
expect from selling the premium. But then on that
For sure.
rebound, when we started using the call spreads to kind of capture the rebound, we're capturing a lot of that. Historically, that would have been a bigger problem for YieldMax, because it wouldn't have captured as much on the way back up as it because it participates so much on the way down. And we're selling calls, right? As those Coinbase calls are coming off, we're selling into new covered call positions. So that, look, and I don't want to cherry pick on coin. Let's take a look at GUI, which we also did the same one, right?
Google. Yeah.
Same kind of time period. Google had a big sell off early last week. We used the call spreads. Yes, we didn't track it as well, but still capturing 4 out of the 5 up is pretty good when you had the decline. Let's look at JPMO,
Yeah,
right?
you could see the chart
JPMO.
there, the little bounce back. So
Yep. Yeah, that's right. You look at those. So this is an example where JP Morgan had a big sell off. What was that date? On the 10th, right? We cover bought our calls, put on new spreads. We're hanging tight with it on the way back up. Still, it's down, right? And we're down a little more than that on this one. I wonder why that's the case. Did I get the right period of time here? But yeah, I mean, it's you captured more of the down. We sold. Again, we're kind of tight to it. Let's see. Here's an example of one where we didn't do it, right? So I don't want to just show all the good news. I always want to make sure I show
this is
everything.
the gold producer
This is the
ETF.
gold miners, GDX versus GDXY. So this is an example of when, gold had this nice little run up, the miners went up all the way through Friday, right? We lagged by 4%. Still made 4, great, right? There's a distribution that's going to be, positive in there from that, but you still lagged by quite a bit. So these are examples of this is what happens, and everybody knows this, where you lack on the upside
On the upside,
participation.
yeah. So
Yep.
you're basically showing that now there's potentially more upside capture, so less lag on the upside, which is pretty much, what all covered call strategies do.
That's
They
right.
lag on the
That's right.
upside, but now we're minimizing it, and you're making an informed, active decision on when to do it. Typically, when you think there might be a bounce up, which is typically happens when there's a big downswing.
Yeah, that's right. So like here's another one where, we've put the call spread on. Let me go back to the date where I actually put it on. Sorry, I think we did it on this day. So again, this is one where with PayPal, right?
Yeah,
And PayPal almost matching on that Monday, we put the call spread on, right? And kind of participating alongside of it. So look, it's meant to do this kind of a thing where we're participating more on the upside to kind of offset some of the decline that we've seen in NAVs, and then but still
good.
not giving up much of the distribution.
That's super exciting. That's super exciting.
Yep.
So
Yeah, this is probably, to me, this is the biggest news, right?
by
And it
far,
took a while to get this through, but
by
it is
far.
big news.
Well, I like that because it's, you guys are always looking to improve the strategy. You're not just just doing a rinse and repeat and that's it. So this is something extra and who knows, maybe down the line we'll have extra even more things as well. So looking forward to it. So, Jay, you've been awesome as usual. Thanks so much for explaining, showing the examples. One last question I have for you, and this is more like, have you heard anything? I've heard that it's possible the SEC is thinking about or looking at daily options, not only on indexes, but for single stocks. Have you heard of anything like that? Do you think, let's say
I
they do,
have.
please share
Well,
anything
that's it.
that you know.
So look, there's a handful of ETFs that are not index based, like USO, GLD, TLT, that have moved to a Wednesday, Friday. I've absolutely heard, talkings from the exchanges that they want to do, some popular names like Tesla and Nvidia to go to multiple expirations within the same week. I think they'd probably follow the path of what the SIBO did, where they first went to a Wednesday, then a Monday, Wednesday, Friday, and then they did all 5 days of the week. I think that's probably the path that some of these names take. But it is absolutely something that's being discussed actively at the exchanges. No doubt about it.
So maybe a gradual, not 5 days a week, not every day, but when you say
Yeah, I
Wednesday,
think it'd be
Friday, that's,
unlikely they would just turn on 5 days, right?
yeah,
But
that would be insane, I think. Would they even, would their hardware even have the capacity to deal with it? I
well,
don't know.
that's also part of the problem, right?
For
You have
sure.
this kind of legacy systems that everybody, all the brokers have that have to then adjust to these things too.
Yeah, they're all gonna have to buy like Nvidia's super speed AI whatever servers
There you,
that they're
there you
doing
go.
whatever, you know.
More reason to buy
Um,
Nvidia if you needed one, right?
yeah, yeah. All right. Well, that's pretty cool news. I mean, I could just imagine, daily options on Tesla or Coinbase or I mean, I like the dailies. I find you have less timing risk, I guess, for the options. So for me, it's interesting. But just to know the popularity and the options is it's all growing in the U.S. as well is good news. I find for funds that do
Yeah,
options in
no,
general,
for
right?
sure. And I'll tell you to not be too far off the YieldMax side. Like Defiance has a fund that USOY that sells options on Wednesdays and Fridays on that ticker, right? So you will see more funds that adopt the higher frequency as well, right? So there's but that's a pretty volatile underlying, right? Oil
Yeah,
is moves around quite a bit, but still, it's one of the reasons why they have it, right? Like I said, gold, silver, TLT, those ETFs have some Wednesday, Friday expirations and stuff that Defiance has filed for. But just in general, options decay faster with less time on a percentage basis, right? So options don't decay linearly. That's why YieldMax doing weekly when we started almost 2 years ago, by the way, at this point,
yeah.
was taking advantage of a more frequent decline in time value in options, which could help you improve the distribution rate. So yeah, from an options perspective, you earn more theta when you have shorter periods. That's all there is to it.
That's awesome. I had something else, but I completely forgot what I was gonna. It happens all the time. What was I gonna ask you? Well, maybe I'll think of it some other time. But Jay,
For
thanks
the
so much
next
for.
interview.
Yeah, you next interview for sure. You'll be back, I'm sure. So, yeah, I mean, thanks for answering the questions about the call spreads, and I think it's fantastic news for the yield max ETFs. I think capturing more upside. I mean, that's probably the number one complaint all these types of funds get. The myth of NAV erosion, I think, is real. For me, it's a myth. It's just like it's more like you don't understand what the fund is doing. But now that
Right.
this should give people a bit more incentive to say, now we have the option of capturing more upside. So thanks again, Jay, and hope to have you back on the channel.
You got it. Appreciate the time.
Take care.